Would you take this gold bar in exchange for buying a house? How about this phone? A new car, maybe?
It might seem absurd, but these were just some of the actual incentives being offered to Chinese home buyers in 2023.
Stories like these were just the tip of the iceberg in a crisis that involved hundreds of billions of dollars in developer debt, trillions of dollars in local government debt, and at least tens of millions of empty apartments.
China is slipping into a period of deflation, often an even worse scenario than high inflation. Here's why falling prices can be so dangerous, not just for China, but also for the global economy. Japan's lost decade is also commonly referred to as a balance sheet recession.
Everyone had kind of run up an awful lot of debt, particularly companies in the preceding, decade or so, and every penny they made went towards servicing that debt. So companies stopped spending and investing, they stopped hiring.
It took 34 years for its stock market to record a new high.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. I was wrong about China. I can't stay quiet on Alibaba, Baba stock, any longer. 2 years ago, everybody was saying that China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction. China shrunk on a relative basis, so they're at risk of no longer being the second biggest economy in the world. And who would have thought that?
Deflation in China isn't just a problem for China, it's also a problem for the rest of the world. Weak consumer spending in China means exporters have to ship goods overseas to find buyers, and that's led to the price of Chinese exports falling too.
Japan, when it entered into deflation and stagnation, was the second largest economy in the world. China is the world's second largest economy, and to have that slide into deflation and stagnation would mean lower global growth overall. So it definitely is a problem for the rest of the world.
They have grown on the back of debt, and they don't really have an outlet. Regarding China, it's interesting because our Canadian economy is very tied to the Chinese economy. Our housing market is very tied to Chinese wealth. Chinese economy at present and how that may impact Canadian housing.
When you look at the US, when the global financial crisis hit, so before that, real estate was 6% of our GDP. And the recovery from that took over a decade, okay?
Yep.
Now, if we benchmark that 6%, real estate is residential real estate, 25 to 30% of China's GDP. And we are now, by the way, at 3% in the US, right? So let's say you cut that in half, it's gonna take at least a decade or two for them to recover. You're looking at Japan is the preview movie, right?
Wow.
It is the preview movie.
We don't want to reinvigorate housing costs, which are off the charts. And rushing households, 55% of household income is going to keep shelter over our heads. In the Canadian economy, we are less productive than we were 20 years ago. We have screwed up. We used a decade of zero interest rates to pump into the least productive segments of our economy consumption. Housing bigger, more flashier doesn't make it more productive as shelter, so we have really screwed up now. Mortgage interest is up 30% year over year for Canadians, and inside of the next 2 years, 45% of mortgages in Canada are up for renewal. Obviously, it's significantly higher rates than when they were written down. The amount of people that can pay the dollars being asked for these assets is just so tiny relative to the bulk of the supply. So this is why I say liquidation event. It's been in the works. It's slow. Real estate cycles take 4 to 6 years to bottom. Everybody loses interest and goes, oh, they hiked rates. We're fine. No, we're not fine. It's a lag and it's coming. And it's evident everywhere you look right now. People are really acting as if the lag effect is not going to happen this time. We have to remember that we hiked interest rates more aggressively over the past 2 years than we've ever done in terms of so many rate hikes in such a short period of time. I think a big mystery has been why didn't the recession that everybody expected at the beginning of 2023 materialized. I think a huge part of that was positive net liquidity that was flowing into the system from a lot of different sources, and it just pushed the timeline out. But it's happened for so long that I think a lot of people have begun to say, oh, it hasn't shown up yet. It's not going to show up. Is it truly different this time? Or is it going to arrive when it does, how much worse it is going to be? We've got this maturity wall of corporations that's really beginning to arrive now. We're going to have almost $1 trillion of corporate debt in 2024. Same with consumer households, and we're already seeing the fact that they are taking on debt like crazy right now. We're at record debt levels. A lot of that revolving credit debt is now at record high interest rates. We have this date with destiny. We're going to get to a point of debt saturation where corporations start re-rating, and then they've got to start cutting costs. Consumers can't keep spending the way that they've been doing. They're really going to start contracting consumer spending. And if corporations react to that by then laying people off, there's a potential for a real downward vicious cycle in consumer spending. U.S. economy is 2/3 consumer spending. That unlocks a lot of pain for us that I think the market is definitely ignoring it right now. Most recessions that we've gone into with 2 quarters of rising consumption when we're already in recession. That's how hard business investment gets slammed. And every single Tim Musk and Mark CEO right now is in a race to do deeper and deeper layoffs. There is a liquidation necessity going on in the world today.
All right, well, Tesla shares tumbling to new multi-week lows on troubles in China, now slowing China shipments and new price cuts in the region, spelling some caution for the year ahead.
See China surpassing Japan. There's Germany at number 3. It's the price of the vehicles coming out of China because of the size and the scale and the cost efficiencies, or what you would say the cost advantages that they have. Take a guess at how much it costs, guys. $9,200 equivalent U.S. dollars. $9,200. I know people will say Americans won't buy Chinese. You know what? You ask somebody, do you want to pay $9,000 for an SUV, or do you want to pay $19,000 or $20,000 for an SUV? No contest. And that's what we found with everybody we've talked to down here. Brand loyalty goes out the window when you have that kind of a price advantage.
Where I was wrong is here. China is a party state. That means the point of the whole place is to maintain the party's control domestically, to enrich the party, and to expand its reach abroad. So we can't talk about sectors in China as if we're talking about the tech sector in Silicon Valley. They don't think about it that way.
Especially in China. This morning, we got this new report from the research firm Counterpoint, and the big headline number here, iPhone sales in China down 24% year on year for the first 6 weeks of 2024. In fact, the only winner of the major phone makers in China, Huawei, surging 64% for that same period.
A huge amount of effort and energy in China to really get that tech independence and to sort of raise up its own producers of phones. So, for example, you know, there's this question of patriotic buying, right? Huawei came out with this new phone that the state media was really touting, saying that this is really a great response to U.S. sort of tech and chip supremacy. And Huawei, in those 6 weeks, while everybody was down, their sales were up 64%, which is absolutely mammoth. And we should also say that this has sort of eclipsed the story, but for Apple, they have a problem in China. They've got a problem here in Brussels, too, with this huge fine that's coming down the pipeline.
The crackdown on the sector is why Secretary Xi was elevated to power in the first place. A decade ago, the party thought that they were losing control over a very powerful parts of the economy. There were CEOs who were earning a lot of money and gaining political clout and power. And that was intolerable in a party state. And so Xi Jinping was installed to reassert the party's control, top-down control. And that's what he is doing. This is the point. I hear a lot of investors talking about China, and gosh, why would they crack down? It's hurting their economic growth rates. No, this is a system that doesn't value human life. It's a totalitarian system and a party state, and it has to be viewed that way. I'm not saying that politics is the only thing, but it's key. It's key to everything else. It impacts everything else. And we have to talk about it honestly, in the language that they use to talk about themselves. That is key. There's all this talk about how the tech crackdown is over, and the original regulatory crackdown was over. That may be true, but what's replaced, it is something I think is a lot more troublesome. If you're an investor, and that is these large companies are being used as increasingly as potential organs of the state. Maybe not directly, but they're a large panda, and when you have a large piggy bank, the party needs to be able to fund all of its social programs and all of its other political responsibilities going forward. It's going to be very tempting to use these companies, whether it's through donations or whether it's through guiding their corporate strategies, to use them as organs of the state. If you're an investor trying to figure out an entry point for Alibaba, it's not just about whether there's some sort of regulatory system keeping these companies down. The question is whether on the corporate governance front, these companies represent what they used to represent, which were these dynamic companies that could do great things and be world leaders in cloud computing, AI, etc. I mean, who has insider knowledge about the current CEO of Alibaba? Who is this Eddie Wu? If you listen to 2 recent quarterly conference calls in English, it's an AI translation of someone talking in Mandarin. You have no idea who is talking, let alone judge their confidence level about the business outlook. The mistake so many investors make is they assume that China works the same way that every other financial system in the world works. It doesn't. It's a non-commercial financial system, and what that means is the economy is run for the benefit of the party in a lot of ways. You're not going to have a liquidity freeze. You're not going to have a single big crisis, a Lehman moment, because the party can simply order lenders to lend, suppliers to supply, and borrowers to borrow. So you're never going to have the same type of freeze up we did in 2008. What you will have be a big ship at sea with holes being poked in it. And you keep plugging up the holes, but in doing so, you're putting good money after bad. You're putting more and more capital into unproductive uses instead of putting it towards innovation. You're paying off old debt. What's the downside to this is that you're going to have slower and slower growth. As more and more capital is diverted to paying off these non-performing loans. What you're looking at is a future with very, very slow growth and eventually stasis. I am talking about GDP that's in the 1 or 2 before long. So this is the downside of the China system as well as the upside. Just look at Alibaba's cloud revenue growth rate recently, around 3%. That's China's big tech in e-commerce, no less. It's not hard to imagine China's GDP growth at 1 to 2% right now. The question is, how long will Alibaba's growth rate stay at 3%? As for my BABA position, I am holding it right now, just waiting and being patient. The single most important message that I can convey to anyone is Xi Jinping doesn't care. When is he going to feel the pain and hit his pain threshold and realize he has to go back to the old ways? The answer is probably never. He's worried about national security priorities. He's worried about building up a domestic chip ecosystem. He's worried about creating paths around U.S. sanctions when they come, which means susceptibility to the U.S. dollar payment system and the U.S. dollar financial system. He doesn't care about the GDP number. He doesn't care about economic data that are driving people crazy. He doesn't care about the stock market other than establishing a floor in the stock market to save face.